Hello and welcome for another episode of the Launch Lab podcast with Tom again. Wonderful. The first one, I think our audience loved it, so why not go for
another repeat.
A repeat. On this one, I wanted to talk on how to raise fund. The reason why this topic, to come back to what we discussed on the first episode on why and how to start a startup, it was, I think there is a lot of myth in this ecosystem, and the biggest one is how to raise fund. What is this venture capitalist? How does everything is down to money in the end. So I'll maybe let you give you the floor. Can you told and explain to the audience a bit more about your history with raising fund, your interactions with VC, and just give a bit of background to understand, because you had a lot of exposure on that.
Sure.
So if you can share a bit of your background, that would
be... Sure. So I'll also just quickly reintroduce myself in case anybody hasn't watched the first episode. So I'm Tom Hewitson. I'm the founder of LabWorks.io. We are a conversational AI startup based here at City. I studied journalism at City about 10 years ago, and worked in the media and then the tech industry before founding LabWorks about 5 years ago. And so I've kind of been through kind of a few things, including fundraising, and I've had some good experiences fundraising and some bad experiences fundraising, and so I'm quite happy to kind of share both, and kind of hopefully demystify some of it.
So let's start. I love playing devil's advocate. I thought, Tom, that VC was supposed to be this, light bubble. They were supposed to be the one leading the pack, with all of their investment, and they should be the one knowing everything through their wonderful tweets on breaking down the future of X, Y, and Z industry. Is it how would you factor this into what you are saying, that apparently they don't know that much?
I mean, it's not a case of they don't know that much. It's not fair to expect a VC to understand the kind of the micro detail of your individual business. In fact, it would kind of be weird, a VC firm will kind of manage hundreds of portfolio companies, and so there's no way that they're going to kind of understand everything. What they are very good at is looking at kind of macro trends, things like what's going on in the broader economy, what maybe even in a specific market. So whereas we are focused on kind of conversational AI, and particularly conversational AI in kind of consumer experiences and gaming experiences, they might look more broadly at generative AI, so including kind of image production, things like Mid-Journey, or if they do look at conversational AI, it would be at a broader, higher level, things like how it applies for call centers and whatever that aren't necessarily of interest to us, but are kind of important indicators of how likely the market is to kind of continue to grow.
I was I got your point. I was purposefully a bit mean towards VC. The reason why is that this is true, just my personal experience dealing with VC, I find that usually, in the absolute, it's true. They are giving macro trend, and this should be their job. Reality, and correct me if I'm wrong, I just feel that some of them, and I'm not going to say most of them, but are misleading in some way, because in the end, having a venture capitalist firm is a business, and their main goal is to have money, but they need to advertise themselves. And I just find it very sad and petty that sometimes they take advantage of founders who do not have that much experience and having deals or positioning themselves as acting on the better interest of the companies, but actually they just serve their own interest, and sometimes they just hold themselves as being this torch on purpose just to attract more people. And what's your experience with that?
I mean,
Is it just me that I have a twisted view, or is it
think
kind of realities that
well,
they
I think
take
like
advantage?
lots of things, like lots of jobs. You know, there are good VCs and bad VCs. You know, founders talk to each other about VC firms, and the VC firms are aware that founders talk to each other about VC firms, and so, you know, it tries to kind of minimise the amount of kind of bad behaviour. I mean, certainly if you're kind of dealing with a VC firm and you're actually thinking about taking investment from them, I mean, the good firms will actually put you in contact with some of their portfolio companies that you can go and talk to. But certainly as a founder, you should take references on the VC firm, because, you know, you are going to be working with those people for at least 10 years, and, you know, in a kind of relationship that is much, much tighter than a kind of traditional employment relationship. You know, like when you are a founder that has taken investments, there is no option to kind of like quit if you don't like it, or, you know, if you find a person annoying to like ask to work for someone else, like, you know, it doesn't work like that. So you've got to be pretty certain before you go into it, and go into it with your eyes open. I mean, you know, raising venture capital, I think has. If I have a criticism of kind of venture capital, it's that a lot of like founders, particularly first-time founders, think that kind of you have to raise venture capital, and that you have to raise venture capital in order to be viewed as a success. And actually, you know, raising venture capital should almost be like a last resort. You know, it's you do it when you need a large amount of money and you don't really have any signals in the business that allow you to kind of go and borrow it from a bank.
And I would like to, you nailed it perfectly, and that's kind of me. I would like to take my lawyer's hat, and this is one of the main advice I gave to some of the startups I had to advise, was that if you want to raise money, raise it when you don't need it the most, because that's when you have the most leverage on the discussion. And I think this is one of the points we had also, like, actually you're the first one who introduced me to this concept, like back when I first joined the lab. We discussed actually on the Gist chat, and I asked you like, oh, how does it work on the VC, because you raised and everything, and you told me like, oh, like everything in life is when you don't need it that you have the most leverage. And I didn't quite understood it, and it took me some time. So can you help our audience guide them through the same advice you give me? Can you give it to them and maybe elaborate on that, like when you said?
Yeah, I mean, you know, the best way to raise money is if you are doing well. Like if you are doing well, and you have got kind of good traction and you're like successful, the VCs will find you. Like, you know, they have venture scouts. Like I'm a venture scout for my VC firm. Like, and you know, they have kind of people out there like around that, you know, report back to them, okay, this startup is doing interesting things, this startup is kind of successful, and you know, they will then go and contact that firm, and that is when you get a good deal. If you find yourself having to kind of like reach out to VC, you'll never get as good terms. You know, the reality is that that doesn't help if they're not contacting you and you need the money. Well, you're still going to have to go and reach out to them, but you should kind of be aware that, like, if you're going to them and asking them, they're always going to have the kind of like the power in the relationship that, you know, that you need them more than they need you. Whereas when you kind of change it around and they're kind of contacting you because they want to be part of your business because they can see that you're succeeding, then they need you more than you need them, and it's a lot easier to get kind of terms that you want.
So the way I connect the dots and what you are saying is that to answer how to raise, well, obviously it's a bit more complicated, but to simplify it, how to raise money is how how do you end up in a position where you don't need to raise money? And to be in this position, you need to have a track record. So having organic growth already, and well, this is the most like the best way of to not needing money is you already have the money coming from your customer. But what I understand what you're saying, but this is not true in all scenario, and it can't be true in some very innovative, like pre-early work. How do you do that? Let's take the case of a startup who has a lot of R&D initial investment required. They can't have any traction. How are they supposed to raise money?
You're absolutely right. And I think this is like that's exactly correct. And it very much depends on your type of business. So if you are building a kind of consumer product, like you are building like an app or whatever, you know, like any VC firm is going to look for you to already have like at least 100,000 users and ideally making some revenue, like, you know.
How much roughly?
Probably in the low tens of thousands, to kind of before they will really talk to you.
Per month or per year?
Per month, like before they'll kind of really talk to you. But if you say you're like a biotech firm, you know, that you're like researching new types of treatments or whatever, of course, like it might take you 10 years, but then you get specialized investors that focus specifically on kind of biotech type stuff, or, you know, where they're very kind of like hypothesis driven, and, you know, those people will kind of invest in that, but they wouldn't invest in like consumer apps. So, you know, if you're in that kind of business, like you will have to go and look for a specific VC firm that focuses on your niche, and often they have kind of close ties with academia. Usually, like where you get those kind of big, you know, where you get like investments with like literally zero traction, that kind of tends to be very like blended with academia, and you often see, like, you know, the firms that I know where they do that, like a good friend that works at a quantum computing startup, you know, they have like several like professors from like like a couple of the big universities in London that are like on the board and in the management, and it becomes really about the team, and, you know, having the kind of like the kind of the real like pinnacle like experts in something in order to do that. So, you know, it is possible to do that, but you have to be basically like a world-renowned expert in the thing that you're doing. It's really an exception. They're very like, those kinds of businesses are very rare for a reason. Like,
so now I'd like to just to come. Stay on the topic of what you said on being an expert, and like this kind of scenario where you are raising fund, because it's kind of touching back to the point we mentioned on the previous episode, like the founder fit, like you are such a strong founder fit, like you just fit all the boxes to actually do this startup, that even if you don't have any traction, you can kind of be forgiven by the fact that you are kind of in a unique position to not only understand the problem, but execute on its solution and be credible in front of your customer. Is it? I'm trying to link those.
So,
is it what you are going towards?
So the thing is that a VC firm will always demand a level of traction from a first-time founder. If you are a second-time founder and you have successfully sold your previous business, they might be willing to give you money like pre-traction, because, you know, you've got a demonstrated track record of building and selling a successful business. But I can't think of any business where a first-time founder has been given money like pre-traction.
I can think of, and sorry to interrupt on that, but this is a funny story. Actually, I had I'm working with a client as his lawyer. He instructed me to work on his some investment scheme there. They wanted to like take advantage. And I asked him, like, the first meeting, I was like, he was getting a bit more than $1 million. And he's very young. And I was like, quite impressed. I was like, how did you do that? And I was like, oh yeah, I've got investors and everything. He didn't know what he was doing. Obviously, he was very young. And I was like, can you tell me what is the name of the VC and everything? I was like, oh yeah, I've got investors. He didn't want to say it. And then when I pushed him, he was like, oh yeah, it's some family members. And I was like, oh, so funny. So how did you end up? I was like, yeah, my dad is like in real estate, blah, blah, blah. So he's coming from a wealthy family, but it's actually a funny story, but it's a reality also on a lot of startups. I would say that some are bound to raise money because startups are actually solving a problem. But what about those founders who are so well connected? And I'm not talking about the family side, but maybe also like, you know, in the end, when you spend so much time in an environment, you just know all the faces of the VC. Like, how much weight would you put on your relationship and the network and the connections you have to raise money? Can it cover up the fact that maybe your startup is failing? Because it looks like from the news, it is in a lot of cases. Well, can we talk about that a bit more about the connection side?
So VCs definitely suffer from FOMO, fear of missing out. The one thing worse than investing in a startup that goes bust is not investing in a startup that becomes a unicorn, because everybody like in the VC industry, they all talk amongst themselves and everybody remembers the VCs that failed. Like the worst thing, literally like the worst thing that can happen to a VC is to have a company pitch them that they say no to, and then it becomes a unicorn, because basically that person's reputation is like ruined. Like, and so they have a kind of if they think that other people think it's going to be a unicorn, they will start like questioning themselves. And so if you have a good network, it is kind of possible to engineer a scenario where everybody is talking about your startup, and so they start to feel like, okay, maybe there is something here. That's like a kind of a general tip for kind of fundraising.
Little trick.
Is that don't just go and talk to one VC, and don't do it in like dribs and drabs, because if you say, right, we're going to like hit it for 2 weeks and talk to everybody, then you will create a bit of buzz about your startup for 2 weeks, because people will be kind of talking to each other and saying like, oh, we've like heard about this startup, are you investing, blah, blah. And if everybody is kind of talking about it, they'll all start thinking, well, if I don't invest and somebody else does invest, then, because often VCs think, oh, well, if I don't invest, like, and the company doesn't raise, then like, they'll come back to me down the line. If things are going well. If it's like a maybe, then, you kind of like, oh, well, I'll just wait and see. Whereas if they think, oh, well, somebody else is definitely going to invest, then they'll be like, oh, well, it's a maybe, but if I don't invest and somebody else does, then I've lost my opportunity to be a part of it. And then you could, and then if that company does become a unicorn, then I'm going to be in trouble. So you can definitely use that to your advantage. To your advantage, but it takes quite a lot of like preparation. You need to kind of really be ready to kind of have everything perfectly aligned, so that when you start, you can just like literally like hit the phone like every 15 minutes for 2 weeks. Like,
last point I wanted to discuss with you before we wrap up. We talked about how to raise money, the different trend, and basically the kind of strategy that could be played. One thing we haven't touched is the geographical impact that it has. I'm taking the case we are in London here. How would you say it's different to raise fund in the UK compared to raising fund in the US, compared to raising fund in Europe? And I would be even more specific, because I've got being in touch with on my first-hand experience, had some founders who couldn't raise fund in the UK because nowadays every application is online, so you just pushed online application on the US, and they got funding from US VC. How do you factor that into account?
Yeah. I mean, the kind of the valuations that you get in the US are a lot stronger. They're kind of like 10 times what you would get kind of for the same percentage equity of your company. Like we have both US and UK investors, and you know, like they, yeah, you know, the US VCs are used to spending a lot more money. I think that they are also, fair to say, like a bit more demanding.
US one or
yeah,
UK one?
US
US one.
investors are a bit more demanding in terms of kind of like what they want from the company, and by that I specifically mean they give you the money, but they want you to spend it and spend it fast. And you know, this is something that kind of people will like. If you've not raised funds, you may not kind of what you won't necessarily like know is that they give you the money, but they don't want. You can't just sit with the money in your bank account.
Yeah, how does it work when you have the money?
Kind of the investors will be like asking you every month, how are you spending it? How are you spending it? They'll be pushing you to spend it. They'll want you to spend whatever it is you've raised within the next 18 months as a maximum. And so sometimes you end up spending money quite quickly and perhaps not as well as if you had spent it a little bit slower. You know, like I've definitely made the mistake in the past of like, you know, spending things on projects that, you know, particularly I'm thinking like some kind of like marketing activity and stuff that was the if we hadn't have been under pressure to spend and to kind of meet like very like strong growth targets, like we wouldn't have necessarily done, because we could have got that same effect in a much cheaper way if we had you know, been able to kind of take the time to build it organically. And I think that you know, that is kind of taking investment does change your business, and not always for the better. I think that a lot of people that kind of raise investment, you know, I think even like I've felt at times, it makes everything a lot more complicated, a lot harder, and you know, you really need to be kind of certain that it's the right course of action. I would say for most people, you know, you really should try and avoid it at all costs, if you can. You know, particularly, you will have a much more pleasant experience if it is your first business, if you build a business that you can get to profitability on your own. You know, there is no rule in life that says that you are only allowed to found one business. You know, if this is your first time, do yourself a favor and build something that you can make a profit off without getting investors in. Make sure that you've understood how to kind of run a business, how to kind of make it a success before you start, you know, throwing petrol on the fire, because once you start throwing petrol on the fire, if you're not careful, your eyebrows get singed.
Well, I love this this analogy. I'll just try to conclude with a little bit of my personal advice on that. Would be really to see VCs, or actually the best VCs would be the one coming, giving you cash, and just shutting up, like not being like. So
I don't know whether I'd agree with that.
Yeah.
I think that you know, the best VCs are there when you need them, and when they're kind of, when you don't, they're not. Like, I mean, ours are generally pretty great. Like they you know, they kind of, when we've needed like help with something, they lent us like a member of their team for kind of like 3 weeks to come and like work with us on a project. They did a load of kind of like market research on our behalf at one point, which was really helpful. They like, you know, recently with the collapse of Silicon Valley Bank, they kind of went round all the kind of portfolio companies and were like, you know, just want to check you're all okay, like, you know, but like, just remember that the most important thing is that, you know, like, put your kind of personal life before the business, like make sure you're taking breaks, make sure you're looking after yourselves. Like, you know, the best VCs, they don't want you to kind of like burn out. They want you to be successful.
Them wanting you to be successful is part of the deal.
Yeah,
That
yeah,
I understand, but me as a lawyer, if tomorrow I've got a client coming, I had some client who came to me for some deal, and then easily the relationship turns into like them asking me business advice and them turning it, asking me like some more, oh, by the way, I've got something that I don't deal with, like family law. By the way, I've got this family issue. Like, I'm a lawyer giving you advice on a specific issue. Even though I could give you this advice, I shouldn't overstep. And my point with VC is being a venture capitalist fund is like you are providing cash to the same way that your lawyer is providing you legal advice, to the same way that your doctor is providing you medical advice. Of course, maybe your doctor knows a lot about art, but isn't it that they should stick to what is best? And same way with the VC. I understand that your VC may have done a lot of work on marketing or helping you out, but is it really their role to do that?
Yeah, no, I don't agree
what I
with
mean.
I don't agree with what you're saying, because, you know, if you want just cash with no opinion, go to a bank, like take a loan, like, you know, that's what the bank is for. The bank will never tell you what to do with the money. They'll give you a loan, and you know that like the VC is buying a portion of the business. The VC owns like 10-20% of your business. Like, they've got every right to have an opinion on how the business is run. Like, you know, that is a completely reasonable thing. And also, they are part of their business. It's like hiring a team member. It's, you know, having a VC is like, you know, a member of the staff. They sit on your board. They, like, you know, they're a really integral part of the company. And I think if you approach it with a I just want money from you attitude, that relationship won't be very successful. And the reality is that most startups take at least 10 years before they sell. And so you're going to be stuck with these people a long time. So you want to have a good relationship. You want them to care about the business, because you're going to be spending 10 years like having monthly meetings with them. Like, you know, you don't want to kind of have monthly meetings with someone that doesn't really care about what you're doing. Like,
well, makes sense. I think that, it's just my personal experience. I've seen more horror stories of, I think that, this would be the topic maybe for a next episode of like all of those horror stories of, because when you're a lawyer, you come when it's like bad timing most of the time, and you can hear all of those. I understand, I don't know how good, or maybe you are like in a very unique situation where your VC is treating you very well, but I've, on the other side, heard stories or where like, actually in this situation, it would have been so, well, actually, as you said first, you shouldn't have raised fund, but after you raise fund, like, you would have been in a so much better position just to like get the money and not having to nurture a relationship that was more toxic than anything. So I think that, is it fair to say that you have, or you are maybe also lucky to have a very good relationship with your VC and who actually care and who are professional in what they do, but it is true also to acknowledge that in a lot of cases.
I think
there are some horror stories, you know.
I think that actually, I think most startups are quite happy with their VCs. I think most VCs are quite good, but this is what I was saying at the beginning about do your due diligence. Make sure that you've taken references before you work with them. Like, it's a good idea to go with a VC firm that's got a good like reputation and stuff. You know, they like if they've put a lot of effort into maintaining that reputation and building that reputation, they're less likely to want to like ruin it. They know that founders talk to each other. I think that it also goes back to kind of what I was saying about if you're a first-time founder, if you really can, like, don't stay away from VC funding, do a business that doesn't require it. Like, make sure that you are really confident in your abilities to run a business before you kind of take on a VC, because it's a lot easier to manage, you know, somewhat a relationship where maybe the VC's like asking you for stuff that isn't like good for the business to provide, if you are quite confident in what you're doing and you kind of, it's easier to kind of push back on than if you're kind of starting out and you feel like you need to kind of please them a lot. So yeah, I think it's a lot easier to kind of deal with VCs if you've got a bit more experience. So yeah.
Well, Tom, thank you very much for this episode. I think we've covered most of the topic we needed to cover on how to start. How to raise money from VC. On those nice advice, we're gonna wrap up. Thank you, Tom, for being here, and we will see you next week.
Nice.
Cheers. Thank you.
Bye.